Today, I'm going to reveal the single most powerful candle pattern that signals the beginning of massive trend moves, the kind that can transform your trading account if you know exactly what to look for, and, more importantly, how to stay in the trade once you've entered. Have you ever watched a stock explode 50%, 100%, or even 200% higher and thought to yourself, I saw that breakout but sold way too early? That sinking feeling in your stomach when you realize you left thousands of dollars on the table because you couldn't resist taking that quick 10% profit. Trust me, you're not alone in this struggle. Let me share something crucial that changed my entire trading career. The first rule for catching truly significant market moves isn't finding the perfect entry. It's learning to sit tight when the market proves you right. Has this ever happened to you? You spot a perfect setup, enter the trade with confidence, see some quick profits, and then that voice in your head whispers, "Take the money before it disappears." But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Most traders, even those with years of experience, struggle with this psychological trap. They can identify strong breakout candles, but lack the discipline to ride the subsequent wave. They snatch at pennies while dollars are running away. This pattern repeats endlessly in trading, creating a cycle where you're constantly working hard but never building substantial wealth. The truth about breakout candle patterns, the ones that signal major trends, is that they're not just about the technical formation, but about what they represent. Institutional money flowing into an asset. When you see that powerful price action combined with significant volume, you're witnessing smart money positioning before a major move. Stay with me until the end, because what you're about to discover might surprise you about how simple this pattern really is once you train your eyes to spot it. The psychology behind profit-taking is perhaps the greatest obstacle between average traders and exceptional results. That irresistible urge to grab quick profits feels like the safe, smart play in the moment. But this common trap leads to the most painful trading experience of all, being absolutely right about the direction, but missing 80–90% of the move because you couldn't overcome your emotions. What fascinates me is how this pattern appears across all timeframes and in all markets: stocks, Forex, crypto, futures, signaling the same underlying market dynamics that have existed for over a century. The candle formation we're discussing today has predicted some of the biggest moves in market history, from Amazon's rise after the dot-com crash to Bitcoin's explosive rallies. The real question isn't whether you can spot this pattern, I'll make that crystal clear in a moment, but whether you can develop the mental fortitude to act on it properly when it appears. Can you overcome the psychological barriers that have held you back from truly life-changing trades? If you want more of these trading insights that go beyond basic technical analysis, hit that subscribe button now. I'm constantly sharing the strategies that separate professional traders from the crowd. The truth is, the market has its own language, a silent communication system that reveals its intentions if you know how to decode it. This breakout candle pattern I'm sharing with you today is essentially the market whispering its secrets, telling you where smart money is flowing before the crowd catches on. It's like having access to an insider conversation without breaking any rules. When you witness a stock forcefully break out of a consolidation range, accompanied by substantial volume increases, you're not seeing random price action. You're witnessing a fundamental shift in the market's perception of value. These powerful movements represent the beginning of a journey that could transform your trading results if you recognize the pattern early enough. The hidden truth most trading educators won't tell you is that these breakout candles are the visible manifestation of invisible forces. large institutional investors who've completed their due diligence and are now deploying capital. They can't hide their footprints on the chart, and these footprints create our edge as pattern-focused traders. Now, I want to go even deeper into this topic and address perhaps the most counterintuitive aspect of capitalizing on these breakout patterns, the waiting game. This is where the real mindset shift happens for most traders. We've been conditioned to believe that successful trading means constant action, analyzing, entering, exiting, and repeating. But the revelation that changed my trading career was understanding that the largest profits don't come from frequent trading, but from patient waiting, followed by decisive action when the perfect setup appears. The most profitable strategy often involves doing absolutely nothing for extended periods. This waiting phase creates tremendous internal tension because it contradicts everything we feel we should be doing as traders. Your brain craves the dopamine hit of action, but true trading mastery comes from overriding this impulse and embracing strategic patience. Think about the impact this one decision makes, waiting for the perfect breakout candle pattern versus jumping into mediocre setups. The former leads to higher probability trades with better risk-reward ratios, while the latter keeps you trapped in a cycle of small wins and frustrating losses. Consider this. Some of the most legendary traders in history made the bulk of their fortunes from just a handful of trades each year. They weren't constantly active. They were selectively active. They waited for the market to reveal its hand through specific patterns, then committed with conviction when those patterns appeared. The journey toward trading mastery isn't about learning more indicators or systems. It's about developing the discipline to wait for the perfect setup and then having the courage to stay with it once it begins. This fundamental shift in approach separates consistently profitable traders from the masses who continuously struggle. I'm curious, which do you find more challenging? Identifying the breakout candle pattern or having the patience to wait for it? Type pattern or patience in the comments below to share your biggest struggle. Your answer helps me create content that addresses your specific needs. Let me share a crucial distinction that transformed my own trading journey. Many people confuse speculation with investment, thinking they're the same approach with different time frames. This misunderstanding leads to fundamental mistakes in how they manage trades once they've identified that perfect breakout candle. An investor buys with the intention of holding indefinitely, through thick and thin, often for years or decades. They're playing a completely different game. As speculators using this breakout candle strategy, we're not marrying our positions, we're dating them. We ride trends while they're active and viable, then exit when the pattern tells us the move is exhausted. This mindset shift creates a powerful revelation. You don't need to predict exactly how high a stock will go after the breakout candle appears. You simply need to recognize when it's acting right, showing the characteristics of a healthy trend, and stay with it until those characteristics change. The market itself will tell you when it's time to leave the party. What fascinates me about this approach is how it aligns with human psychology. We're naturally wired to make quick decisions based on immediate feedback. But in trading, this instinct works directly against our financial interests. The breakthrough comes when you realize that holding a winner through your emotional urges to sell creates a multiplier effect that can completely transform your results. Behind the scenes of nearly every trading success story I've encountered is this same pattern. One strong trend, followed with discipline, outperformed dozens or even hundreds of small trades combined. It's not about frequency, it's about magnitude and duration. Consider this impact. If your typical trade nets you 10 to 15% before you take profits, what would happen if you applied this breakout candle strategy and held just one position through a major trend move of 100%, 200% or more? That single decision, to hold rather than fold, could literally account for more profit than all your other trades combined over an entire year. I've seen traders make this fundamental shift in their approach and experience not just better results, but a complete transformation in their relationship with the market. The constant anxiety of day trading gives way to a calmer, more deliberate process where you're looking for fewer, higher quality opportunities. The multiplier effect of patience creates a compounding advantage that most traders never experience because they can't overcome their emotional response to seeing profits in their account. They grab at immediate rewards, while sacrificing exponentially larger gains that require only slightly more time to develop. What's particularly powerful about focusing on these breakout candle patterns is that they often mark the beginning of moves that last far longer than most traders anticipate. By identifying these patterns and committing to ride them without prematurely cutting profits, you position yourself to capture the meat of major trends, while others are jumping in and out, paying commissions and missing the bigger picture. Drop a 10x in the comments if you've ever sold a winner way too early and watched it continue climbing without you. I think we've all been there, and acknowledging this common experience is the first step toward changing it. Now, let's dive into the exact anatomy of this powerful breakout candle pattern that signals the beginning of major trends. This is where the rubber meets the road, the practical revelation that will transform how you view chart patterns forever. The breakthrough candle that precedes significant moves has distinct characteristics that make it stand out from ordinary price action. It's typically a longer than average candle that forcefully breaks through a clear resistance level or consolidation pattern. The candle closes near its high, showing conviction and strength rather than indecision. This decisive move higher after a period of base building is essentially the market announcing a fundamental shift in sentiment. What's fascinating about this pattern is how it represents a pivotal moment in the stock's journey, the exact point where supply and demand dynamics dramatically change. Behind every breakout candle is a story of accumulation followed by recognition. Smart money quietly builds positions during the base formation. Then the breakout candle marks the moment when broader market participation begins. But here's the critical insight many traders miss. Not all breakout candles are created equal. The secret ingredient that separates meaningful breakouts from false moves is volume, the heartbeat of genuine market conviction. Without substantial volume confirmation, even the most picture-perfect breakout candle might be nothing more than market noise. When you observe a price breakout accompanied by volume that's significantly higher than the stock's average trading volume, often 200% to 300% above normal, the market is essentially shouting that something important is happening. This volume signature reflects institutional participation and genuine conviction behind the move. The revelation that changed my own trading was understanding that volume doesn't lie. Price can be manipulated in the short term, especially in lower liquidity environments, but volume represents actual money flowing into a security. It's the invisible hand of the market made visible on your chart. Think about the breakthrough moments in your own life, those times when you didn't just talk about making a change, but actually committed resources to it. That's what volume represents in the market, not just interest, but committed capital backing up that interest. It's the difference between casual browsing and actual buying. What I find most powerful about this volume-confirmed breakout pattern is how consistently it appears before major market moves across decades of market history. From the railroad stocks of the early 1900s to today's technology leaders, this pattern has preceded countless significant trends, making it one of the most reliable signals for traders who know what to look for. As you review your charts tonight, look for examples of strong breakout candles with corresponding volume spikes that led to major trends. Was there a particular technical signature that appeared consistently before the biggest winners in your watch list? Type, "I see the pattern" in the comments if you've spotted this formation in your own trading and are starting to connect these dots. The timing of your entry. After spotting this powerful breakout candle pattern is absolutely crucial to your success. This is where many traders face a pivotal decision moment. They see the pattern forming but hesitate, paralyzed by the fear of being wrong. Let me share a revelation that might transform your approach to these opportunities. The ideal entry window opens after the breakout candle has confirmed itself by closing strongly above resistance, but before the larger trend has fully developed and become obvious to everyone. This sweet spot represents the perfect balance between confirmation and opportunity. The price has shown its hand, but the bigger journey is just beginning. What makes this timing so powerful is that you're positioning yourself at the earliest stages of what could become a major move. Think of it like getting on a train right after it starts moving, rather than running to catch it once it's already gathered speed. The former requires timing and courage, while the latter requires desperation and often leads to poor entries. Don't miss out on future videos where I break down powerful trading patterns like this one. Subscribe now and join thousands of traders who are transforming their approach to the markets. The hidden truth that experienced traders understand is that perfect timing rarely feels comfortable. When you're entering at the optimal moment after a breakout candle, you'll often feel a mixture of excitement and apprehension. That's completely normal. The crowd is still skeptical at this stage, which is precisely why the opportunity exists. Now, let me address something equally important: the risk management framework that protects your capital while giving these breakout trades room to develop. Without this critical element, even the most perfectly timed entry can lead to disaster. Every position based on this breakout candle pattern needs clear, predefined risk parameters. This isn't just about limiting losses. It's about creating the emotional freedom to let winners run. When you know exactly where your exit is if you're wrong, it becomes much easier to hold positions through the inevitable fluctuations if you're right. The most elegant approach I've found is setting your stop loss based on the pattern structure, typically below the breakout level or the low of the breakout candle itself. This mechanical approach creates a buffer that protects your capital while giving the trend enough breathing room to develop without getting shaken out by normal market noise. Behind the scenes of every successful trader's process is this same disciplined framework. They don't just spot patterns, they manage risk with surgical precision. The transformation happens when you shift from thinking primarily about how much you could make to focusing first on how much you could lose. What's particularly powerful about this approach is how it automates your decision-making. By establishing these parameters before entering the trade, you remove much of the emotional turbulence that typically accompanies holding positions through volatility. Your stops aren't based on fear or arbitrary dollar amounts. They're strategically placed based on the market's own structure. Have you ever been shaken out of a good trade because your stop was too tight, or held a loser too long because you had no clear exit plan? Drop a structure-first comment if you're committed to implementing this structured approach to risk management in your next breakout trade. Let's talk about a crucial element that separates professional traders from amateurs: position sizing strategy. This often overlooked aspect of trading is where true mastery begins to emerge. Think of position sizing as the bridge between identifying great breakout candle patterns and actually transforming that knowledge into consistent profitability. Your position size should directly reflect both the quality of the setup and your confidence in the breakout candle's characteristics. A pristine pattern, one with perfect consolidation, explosive volume, and clean technical structure, warrants a larger allocation of your capital. Conversely, setups that meet most but not all of your criteria deserve smaller positions. This nuanced approach creates a beautiful alignment between opportunity and prudence. The revelation that changed my own trading journey was understanding that not every breakout deserves the same capital commitment. Behind the scenes of professional trading is this proportional approach, scaling position size based on setup quality rather than treating every trade identically. This mindset shift does something remarkable. It reduces the pressure on any single trade while simultaneously maximizing your exposure to the highest probability opportunities. Instead of the binary all-in or stay-out approach that traps many traders, you create a spectrum of commitment that mirrors your analysis. Now, let me share another transformative concept that complements this approach: the first target framework. Rather than falling into the trap of trying to predict exactly how far a trend will ultimately go, something that's nearly impossible, use the breakout candle's own characteristics to establish your initial profit target. The most elegant method I've discovered involves using the height of the consolidation pattern projected from the breakout point to create what technicians call a measured move target. This isn't random. It's based on the market's own structure and provides a logical first milestone for your trade's journey. What makes this approach so powerful is how it balances the desire for quick gratification with the opportunity for larger gains. When your trade reaches this first target, you can implement a partial profit-taking strategy, perhaps selling 1 tuck 3 or 1 tuck 2 of your position. This creates a beautiful psychological impact. You secure some profits, satisfying that natural urge to take money off the table, while maintaining a core position for potentially much larger gains. The hidden truth about big trend trades is that they often move far beyond what seems reasonable at the outset. By taking partial profits at logical milestones while keeping a core position, you create the emotional freedom to let winners truly run to their full potential. This balanced approach reflects a deeper wisdom about the market's nature. Trends often extend further than most people anticipate, but they rarely move in straight lines. Your decisions around position sizing and profit-taking should reflect this reality rather than fighting against it. What decisions have you been making about position sizing in your trading? Have you been using the same size for every trade or scaling based on quality? Type quality-based in the comments if you're ready to implement this more sophisticated approach to position sizing in your breakout trades. After you've entered a trade, based on this powerful breakout candle pattern, you'll inevitably encounter one of the most challenging phases in the trend's development: consolidation. This is where your patience and understanding of market structure will truly be tested. What happens after that initial exciting move often determines who captures the full trend and who gets shaken out prematurely. Following the initial breakout surge, prices frequently enter consolidation phases, sideways movements that can last days or even weeks. These periods of apparent inactivity are where the true transformation in your trading must occur. While your instinct might scream, "This trade is stalling, get out," the reality is these consolidations are actually healthy and necessary for sustainable trends. Think of these consolidation phases as the market taking a breath before continuing its journey. Behind the scenes of every major market move are these periods of rest and redistribution. The stock isn't failing, it's gathering energy for the next leg higher. This understanding represents a fundamental shift in perspective for most traders. The revelation that changed my approach was learning to distinguish between normal, healthy consolidations and actual trend reversals. The key differences lie in the structure of the consolidation itself. Healthy consolidations tend to form tight price patterns with decreasing volume, essentially a coiling spring. Trend reversals, by contrast, usually show expanding volatility, failed retests of key levels, and increasing volume on down moves. By studying how prices behave during these consolidations, rather than reacting emotionally to them, you develop the discipline to stay with trends through their natural ebbs and flows. This patience, rare among retail traders, is precisely what allows you to capture the full magnitude of major moves. Now, I want to go even deeper into this topic by sharing another powerful confirmation tool that dramatically increases your confidence in these breakout patterns: time frame correlation. This approach has honestly revolutionized how I evaluate potential trades. The most powerful breakout candle patterns don't exist in isolation on a single time frame. When you see alignment across multiple time frames, daily, weekly, and even monthly charts all displaying confirming patterns, the probability of a significant trend developing increases substantially. This multi-layered confirmation acts as a filter that screens out many false signals. Imagine the impact on your trading psychology when you spot a beautiful daily breakout candle, then zoom out to see it's also breaking a weekly resistance level that's been in place for months. This alignment creates a powerful confluence that dramatically increases the odds of a successful trade. What's particularly fascinating about this multi-time frame approach is how it reveals the hidden structure of the market. Significant trends often unfold like fractals, with similar patterns repeating across different timescales. By identifying these harmonic patterns, you position yourself at the intersection of multiple forces, all pushing in the same direction. This holistic view transforms your decision-making process from reacting to isolated signals to recognizing when multiple timeframes are telling the same story. It's like having several independent confirmation systems, all giving you the green light simultaneously. Has your trading changed when you've spotted a pattern that appears across multiple timeframes? Type timeframe alignment if you've experienced the power of this approach in your own analysis. Let's talk about what might be the most challenging aspect of trading this breakout candle pattern effectively: the discipline factor. This is where the inner battle between your emotions and your trading plan reaches its peak intensity. Trading discipline isn't just about following rules. It's about a fundamental transformation in how you respond to market movements. True trading discipline means holding winners according to your predetermined plan, while cutting losers without hesitation or regret. What makes this approach so difficult is that it often feels completely unnatural. It directly contradicts our basic survival instincts. Our brains are wired to avoid pain and seek immediate pleasure, but successful trading demands exactly the opposite response in many situations. The market creates a fascinating paradox. The actions that feel most comfortable are often the least profitable, while the decisions that create the most discomfort frequently lead to the greatest rewards. This psychological reality represents the hidden truth behind why so many technically proficient traders still struggle to achieve consistent results. What I've discovered through years of observing both successful and unsuccessful traders is that the market systematically rewards those who can override their emotional responses and stick to proven principles even when, especially when, it feels uncomfortable to do so. This ability to act against your instinctive responses represents a rare evolutionary leap in trading psychology. The breakthrough moment in my own trading came when I realized discipline isn't about perfection. It's about consistency. It's about making the right decision 80% of the time rather than the comfortable decision 100% of the time. This mindset shift created the foundation for sustainable success with these breakout patterns. Now, I want to go even deeper into what might be the ultimate edge in capturing the full potential of these breakout candle patterns: endurance. This quality separates those who merely identify good setups from those who actually transform those setups into significant profits. The biggest market moves don't reveal themselves in hours or days. They develop over weeks or even months, unfolding in a series of advances, pauses, and further advances. Trading success isn't primarily about finding perfect entries, though that helps, but about having the endurance to stay with trends through their natural fluctuations and developments. Consider the resilience required to maintain your position when a stock pulls back 8% after a 20% gain. Most traders, lacking endurance, will exit at precisely the wrong moment, just before the next leg higher begins. The ability to maintain your position when others are being shaken out is what truly separates consistent winners from the crowd. What fascinates me about this quality is how rare it is among traders. Most market participants can spot patterns, calculate risk, and execute entries with reasonable skill. But the capacity to endure the psychological pressure of holding positions through extended periods, that's the differentiating factor behind extraordinary results. This endurance isn't just about stubbornness. It's about having such clarity in your analysis and confidence in your system that you can weather the inevitable storms that accompany any significant market move. It's about seeing the larger journey while others are distracted by day-to-day fluctuations. If you've ever held a position through uncomfortable volatility and been rewarded with a much larger move afterward, type "worth the wait" in the comments. That experience might be your most valuable trading lesson. As we wrap up today's exploration of this powerful breakout candle pattern, I hope you are starting to see how this one approach could transform your trading results. The ability to identify these high-probability setups and, even more importantly, develop the discipline to ride them through their full development cycle is truly what separates consistent winners from the crowd. If you found value in these insights today and want to continue developing your trading edge, make sure you're subscribed to the channel. Each week I share these kinds of practical, psychology-focused strategies that go beyond the typical technical indicators everyone else is using. I'm committed to helping you see the market through a professional's eyes rather than getting caught in retail trading traps. I'd love to know if this resonated with your own trading experience. If you made it all the way through and something clicked for you today, drop pattern mastery in the comments below. Your feedback helps me create more content that addresses the specific challenges you're facing in your trading journey. If you found today's breakdown helpful, hitting that like button lets me know this approach to trading education is valuable to you. It's always encouraging to see which topics really connect with fellow traders who are serious about mastering this craft. There's a video right here about how to manage your psychology during drawdowns that pairs perfectly with today's lesson. Since we've talked about maintaining discipline through consolidations, that video will give you specific mental frameworks to stay confident when trades test your resolve. Click and continue with me over there. I think you'll find it equally transformative for your trading approach. Until next time, remember that the market rewards patience more than perfection. Trade well.